Hi, everybody. I wanted to give a brief tutorial about Chapter 10, tax depreciation, or what we call cost recovery. So we call it cost recovery because I want you to think, first of all, big picture. Let's say that you invest, and I've got some assets listed up here on the screen. Let's say that you purchase a big computer system for $18,800, okay? The idea of the tax rules is that what we want to do is immediately get access to a deduction in year one, year two, et cetera. The tax rules give us this ability to obtain an immediate write-off or deduction on our taxes, okay? Tax depreciation is an important expense. It is only applicable for businesses. So you cannot, for instance, depreciate your car for personal use. However, if you have a truck or a car used in a business, you can depreciate that. So this is a expense that falls on Schedule C of the 1040 process. So Schedule C, which would give us net income for the net profit or loss for the business. One of the expenses that nets down to net profit or loss is depreciation. Now, what I have up here on the board is the answer to the second homework problem. Now, my numbers might be different from yours, but I'm giving you an example of what this looks like. And what I want to do is I want to lay out what we're looking at, so identify the different pieces of data, and then show you on the screen in a moment where these pieces of data come from, okay? Now, tax depreciation is doing the same thing that financial depreciation is doing. We are depreciating the value of an asset, meaning we're showing the wearing up or the using up of an asset, okay? So we're showing that expense. For the main difference with tax depreciation is that for tax purposes, we show the using up of the asset more rapidly. So there's more expense reflected up front for tax purposes. So, and one way to think about this is we do not use straight line in a tax paradigm. What we're going to do is something more like double declining balance, where we're going to show more upfront tax expense in the front years, meaning the first years that we depreciate versus the last years or the final years. The way that we depreciate is written into the tax rules. So we are not going to be using like a straight line formula. Instead, what we're going to be doing is we're going to be starting out with the type of asset that we have. Is it real estate or is it personal property? Now, personal property, I want to note, is property that doesn't amount to real estate. So anything that's not actual real estate, meaning a building or affixed to the building, would be considered personal property. So think about this personal property as business property that you can move, kind of like furniture, computer equipment, et cetera. Depending on the type of property, we're going to use what the IRS dictates we should use in terms of the method to compute tax depreciation. So what we're going to do is we're going to assume for personal property that what's called a mid-year convention. Now, what that assumes is, imagine if you bought property on, January 20th, or if you bought property at the end of the year, let's say November 15th. So you can buy property at various points in the year. What the IRS rules allow us to do is assume that at any point when we're going to assume that we purchase the property at July 1st, so in the middle of the year. Okay, so the IRS is sort of allowing us, and the rules are sort of creating an estimate here as to, regardless of when the asset was purchased and placed in service during that year, we're going to assume that we're going to start depreciating as of the middle of that year. Okay, now real estate is different. The rules are going to be different. We're going to assume a mid-month convention, meaning we're going to get specific to the actual month and then assume that the real estate was purchased at the middle of the month. Now, this all matters, these conventions, because we're going to be going to tax tables that the IRS gives us, and we're going to look at the mid-year convention tax table or the mid-month convention tax table. This will make more sense when we get to the actual table. What I want you to understand is that we are following a series or a sequence of steps here that the IRS gives us. The first thing to note is we identify the property, then we work backward. We say, okay, the type of property is, we'll determine the type of convention. The type of convention will then determine the type of table that we refer to. The table that we go to, and I'm going to have it up here on the screen in a moment, is going to determine what the rate of depreciation will be. So we're going to see that computer equipment, we're going to depreciate at a 20% rate in year one of when it was purchased. Now, one final nuance here as part of the big picture. Personal property I mentioned up front versus real estate property. Let's look at personal property in a little bit more detail. What the IRS does is they bucket personal property assets into class lives, okay? So computer equipment, for instance, has a 5-year recovery, and this is like an estimated useful life, okay? When we talk about the class life, we can think about this as recovery period, meaning, and from a financial accounting perspective, this is like kind of like estimated useful life, okay? That's kind of the sort of parallel here. So we are given these class lives. Real estate will always be 39 years. Depending on the type of asset, it will be 5 years, 7 years, or maybe a potential other length of time. Again, the IRS gives us these amounts. The homework number 2 gives us these types of assets: computer asset and furniture. Computer equipment is 5 years. Furniture is 7 years. Let's take a look at how we actually go from a 5-year, or from the name of the asset to the class life to the percentages, and we'll do that next on the screen.
Take a look at where we go, or how we get to this idea that in our homework example, for instance, that computer equipment is a 5-year asset, or that furniture is a 7-year asset. And what I've got here up here on the screen is a call out from your text, which shows an excerpt from Revenue Procedure 8756. So this is IRS guidance. I think what's important to know is that this table that we're looking at, where we have a listing of types of assets, and we're given the general recovery period. Again, furniture is 7 years. We can see that on line 1. Computer equipment is 5 years. Let's do this. We're going to open up, or we're going to look at one of these tables. Now, the homework problem gives you 5 tables. These are the tax tables that give us the depreciating amount. This is the half-year convention for personal property. So this is a tax table that we would know to come to, because with furniture and equipment, we are dealing with personal property. The rules tell us to come and look at the maker's half-year convention table. So some of this is just stepping through a sequence of rules that we are told to step through. Okay, so I want to make sure that's clear, that what we're doing here is we are coming to this table because we are instructed to. Now, if you notice, we were told in the homework problem that we were in the first year of depreciation. So what we're going to be concerned with here is this first row. And what we're going to do is we're going to look across at the columns, and we're going to look at 5-year assets and 7-year assets, because we're told that the computer equipment is a 5-year asset and the furniture is a 7-year asset. You notice 20% is the 5-year asset year 1 depreciating rate. And for the furniture, which is 7-year class asset, it's a 14.29% rate. So that's where we get our rates from. We multiply these rates times the depreciable basis, or by the original, the cost that we're given, and that gives us our depreciation. Okay? Let's take a look at the real estate. Non-residential real property mid-month convention, straight line, 39 years. That's kind of a mouthful. This is what we're looking at here, this table. This is for the building, because the building is real property, it's real estate. And this is a different convention. Because it's real estate and not personal property, we're going to use the mid-month convention. Again, we are in year 1, and we purchased the building in October, which tells us that we come over to month 10, and this is going to be the rate at which we depreciate. So if we go back to the example that I had up on the whiteboard, the depreciating rate for the building would be 0.535%. So these are the steps. These are the steps to compute depreciation.